Are you wondering how to start trading options? Imagine turning your knowledge of the options market into returns that could boost your portfolio, where you could make money in an up market, in a down market, in a sideways or stagnant market, or even in a volatile market. In this Options for Beginners video, we're going to guide you step by step in understanding the basics, and you'll even learn a strategy that you can start using right away, so stay tuned. But first, ask yourself this. What if you could make your money work smarter, not harder? Stick around and I'll show you exactly how to get started with options the right way. Plus, I'll share with you a personal story about how I made my first successful options trade and what it taught me, and how I learned how you can minimize risk and optimize the probabilities of your potential gains. Here's the thing. Most new investors avoid options altogether because they think they're too risky or they think they're too complicated. But when used correctly, options can be a powerful way to enhance your portfolio. You can use them to hedge your investments, generate income, or even speculate on bullish or bearish markets and protect yourself in a declining market. By the end of this video, you will not only understand what options are and how they work, but you'll also learn a beginner-friendly option strategy that you could start to use right away with confidence. And trust me, you don't want to miss out on this strategy. It is a game changer, and I will share it for you at the end of this video. I still remember my first time trading options. I was nervous and I wasn't sure if I had made the right decision. But the lessons I learned that day set the foundation for my investing journey. So let me show you how you can skip the mistakes and start off strong. Hi, my name is Davidson, and I am a seasoned options trader and educator. I have spent the last 25 years not only trading options, but helping teach people how to trade options. I have taught tens of thousands of people how to trade options and helping them go from not knowing what they're doing to having sound strategies and rules and discipline that they can use to generate income, speculate on the markets going up or down, and to protect their assets. And the one thing all of our students have told me over the years is that we make options trading simple, and that's important. In this video, we're going to cover what options are and why they matter. We're going to talk about the risks and benefits, or the pros and cons of trading options. And we're going to talk about how options work in the real world. Plus, as promised, we're going to give you an option strategy that is beginner friendly that you could start using right away. What is an option? Well, let's start with the basics. An option is a contract. Another word for option is choice. And an option can give you, the buyer of the contract, the right, but not the obligation, to buy or sell an asset like a stock at a predetermined price called the strike price on or before a predetermined expiration date or a specified expiration date. Think of it like a reservation. You're locking in the price of something right now without committing to the purchase just yet. Now, options come in two types. There are call options that give us the right to buy the underlying asset, and there are put options that give us the right to sell the underlying asset. Let me illustrate a simple example for you. Imagine you're planning to buy a concert ticket, but you're not sure if you're going to be able to attend the concert. But you don't want the ticket prices to go up because everybody wants to go to this concert, right? You can lock in the current price, giving you the option to buy it later at the price agreed upon if you decide you're able to go to the concert. That's essentially how options work. Now, if you decide you're unable to go to the concert, you are going to forego that little fee you paid to make that reservation. And you're willing to take that risk because you really would like to go to the concert, you don't want to pay too much, and it doesn't take that much money to make the reservation. That's essentially, again, in a nutshell, how options work, except for instead of concerts, we're talking about stocks, of course. There are pros and cons and some benefits and risks to trading options. Now, the benefits are awesome. We get leverage. With options, you can control a large position with less capital. This means you can potentially get greater returns. You can see greater returns with a smaller capital outlay. And that is one of the good things we really love about options, is using that leverage. Flexibility. Options allow us to profit in a rising market. We can profit in a falling market. We can generate cash flow and income in sideways and stagnant markets. And we can make big returns in volatile markets where price is moving fast. It's all about choosing the right strategy and having some good timing. You can also use options for hedging. You can use options to protect your individual stocks, buying insurance on those assets. You can also use put options to protect your entire portfolio against market downturns. And that's a great feeling. We can act like the insurance company and sell options and generate that income for ourselves. So we can play both sides of the options contract. We can be the buyer of options, where we have the right, but no obligations, to buy or sell those assets. But we can also be the seller of the options, where we get paid the premiums. We receive the money in exchange for making some promises. A promise to either buy the asset from the put option buyer, or a promise to sell the asset to the call option buyer. We can play both ways. Now, some of the risks are that options can expire worthless if they are not managed properly. That means you could lose the premium that you paid. Just like the concert ticket, if you end up not going to the concert, you paid the premium to lock in that price, but you didn't take advantage of that option. Now, when we buy options, the risk is that the options will expire worthless. But when we sell options, we're hoping that those options expire worthless. In fact, statistically speaking, about 80% of all options contracts expire worthless, and the option is not going to be exercised. Some of the other cons or risks of trading options is that some strategies are a little bit more complex and require some skill and knowledge on how to manage them. And it can lead to significant losses, particularly for beginners, if you don't know what you're doing. So it's worth taking the time and effort to learn how to implement the option strategies properly. The other thing we need to know about options is that they are time sensitive in nature because there is an expiration date. And one of the things that I learned about options early on is that when we buy options, it's wise to buy more time than you think you're going to need. Buy a lot of time on those options contracts so that time doesn't work that hard against you. And when we sell options, it's wise to sell only 1 or 2 months at a time so that the rate of time decay benefits us and the probability of those options expiring worthless increases. So here's some personal insight. When I first started trading options, I underestimated the amount of time decay and how it would affect the option premium. Watching the value of the options erode as expiration date approached was a tough lesson for me. But it was an important lesson, and it helped me understand the importance of timing and making sure you have the right contracts. Because we get to choose when we buy options whether we want to buy a long-term contract, an intermediate-term contract, or even a short-term contract. And when we sell options, we can sell long-term contracts if we want, but most professional traders will sell option contracts short term to collect those premiums and to take advantage of the probability that those options are going to expire worthless, meaning we get to keep the capital. Cha-ching, cha-ching. There are 3 important aspects to options contracts that you need to understand. Strike price is the agreed upon price where we can buy or sell the underlying asset. Now, the reason we call it the strike price is because that is the price where the buyer and the seller come together and they make a deal. They agree to strike a deal with a handshake and signing a contract, so to speak, with a click of a button. You can buy or sell that contract, and that strike price is locked in. There's an expiration date. Now, we can choose long-term options, intermediate-term options, or short-term options. Expiration date. That is the date by which you must exercise your option. It can be done on or before that expiration date. And when we are the buyer of the option, whether or not we exercise that option is our choice. When we are the seller of the options, and we're the ones receiving the premium, we have an obligation to make good on that promise, to deliver the underlying asset or to buy the underlying asset at the agreed upon strike price on or before the agreed upon date. Let's say, for example, that you're eyeing a stock that's trading around $100 per share, and you believe that the price of the asset is going to rise in value up towards $120 per share. Instead of buying the stock outright, which would cost you $120 per share, you can purchase a call option. And imagine that that call option costs just $5 per share. If the stock price increases and reaches that $120 value, your option contract, the premium is going to increase significantly. But if the stock doesn't make that move, if the stock price stays the same or goes down, you'll only lose the $5 of premium that you paid. Now, the interesting thing is if you buy the stock at $100 per share, the stock price could go all the way down to zero. And it's not likely, but it's possible that the stock price could drop from 100 down to 90 or down to 80, and you could lose $10 or $20 per share. With the options contract, the benefit is you only would stand to lose the premium you paid. So if you paid $5 for that contract, the most you could lose is $5 per share. Options contracts are typically dealt in 100 share increments. So a $5 option contract would cost you $500, whereas 100 shares of a $100 stock would cost you $10,000. Now you can see how important that leverage is. And if the stock price rose to $120 per share, you'd make $20 per share on the stock, and the option contract might only go up $15, but the ROI, the return on investment on the option contract, would be 300%, whereas the return on investment on the stock price would only be 20%. So you can get a lot of bang for your buck, big returns on options. Now imagine using this strategy to just speculate. Whether the market's going up, we can buy call options, or if we think the market's going to go down, we can buy put options and speculate on the stock price falling. For example, if we had that stock trading at $100 per share and we thought the stock price was going to drop down towards $80 a share, we could reserve the right to sell it at $100 per share. And if the stock price went down towards $80 per share, we could buy the stock at $80 and put it to the person who sold us the contract at $100 per share. We get to put that to them. Trading options can be really exciting and a lot of fun, and it can be a great way to enhance or to boost the rates of returns at which we get. In fact, a couple of years ago, I had a student come to me who was a little bit behind on their retirement goals, and they wanted to be able to generate a higher rate of return without taking too much risk. And they found an option strategy for you. I'm going to show you here in a moment that they were able to implement, and whether the market was moving up, down, or sideways, they were able to generate the types of returns they were looking for to help them meet their financial goals. Now, here's a beginner-friendly strategy that you can use to get started. It's called the cash secured put. And with this strategy, the cash secured put, we are going to act like an insurance company. Now, you probably pay insurance for either your car, your home, your health, whatever it is. We can buy insurance on just about anything. The insurance company is happy to sell us insurance because they do all the math, they calculate the probabilities, and they figure out how much premium they need to charge in exchange for the coverage that they provide. Now, the insurance companies get rich by simply promising to make good on the asset. If there was an accident, say your home burned down or your car got in a wreck, they would restore the value of that to you because you paid a premium and you had a contract and they agreed to cover that asset. So now, did you know that we can do this with stocks? In fact, this is one of Warren Buffett's most well-known strategies. It's called, again, the cash secured put. And we, like Warren Buffett, who, by the way, happens to own a major insurance company, can insure other people's stocks for them, and they will pay us a premium today. Now imagine there's a stock that we really want to own. Let's say it's trading for about $50 per share, and we can sell a put option at the strike price for $45 a share. So I'm going to repeat those numbers for you. Let's imagine that there's a stock we really want to own. It's a good company, and that the stock is trading around $50 per share. Now let's imagine that we sell a $45 put contract, which is us making a promise to buy that stock at $45 per share for the next, say, 2 months. Now let's imagine for a moment that the premium for that contract was $2 per share. That would be income to us for simply making a promise to buy a stock that we want to own anyway. Now, if the stock price were to drop down below $45 per share, the person we sold the contract to could exercise their right to sell us the stock, and we would take it. And we would be happy to take it. We get to keep the premium. We get to keep the $2 per share premium. And we buy a stock we own at a great price, $45 per share. Now, if the stock price never falls down below $45 per share, let's say it stays at 50 or the stock price even goes up, that option contract is going to expire worthless. And we get to keep the premium, and the person who bought the insurance, their contract expires at the end of the agreement. Just like your insurance. Now, have you ever thought for a moment that you were glad you didn't have to make an insurance claim? That you paid for your insurance on your car and you didn't get in a wreck? And you were like, oh man, I went another month paying my insurance premium without making a claim. No, you're glad that you didn't get in a wreck. You're glad that you didn't have to make a claim. And the insurance company gets to keep that premium for providing you that peace of mind. That's a valuable service. And that's why this strategy is so powerful. We get to provide a valuable service where we act as the insurance company, and we promise to buy assets we really want to own anyway, and we get to choose the strike price at which we want to make the purchase. And if the stock price were to fall and we had to make good on that promise, we have the cash on hand to pay for it. So what that means is you can get paid to buy the stocks you already want to own and get paid those premiums. And I can do that month in and month out. I could sell an option contract every month, every 2 months. We typically sell short-term options contracts so we can collect the premiums and make those promises short-term. And we typically look to implement this strategy with an 80% probability that we never end up owning the stock and we just get to keep the premium. Well, that means there's a 20% probability we will end up owning the stock, and that's okay because sometimes the stock pays a dividend, or we can even turn around, and if that stock price rises, we can profit from it. If the stock price doesn't go up and we want to get rid of the stock, we can sell a call option and get somebody to pay us to take it off of our hands. Did you know that? So we can get paid to buy the stocks we want to own. We can get paid to sell the stocks when we want to get rid of them, when you know how to trade options. The cash secured put is a really straightforward strategy. Again, we're acting like the insurance company. We're selling a contract, making a promise, and getting paid a premium. And those premiums can be really high ROIs. Again, per month, every couple months. You can do it several times a year and generate real income, new income. Now, let me share a story with you about one of my students who was using the strategy, and we talked about them a moment ago, but this is a well-known tech stock. And over the course of a year, they collected premiums in the amount of about a 10% annual return without actually ever buying the stock. Their money was safe in their account, ready to buy the stock at the agreed upon strike price, but the stock price never went down, and so the person who they sold the put option to month in and month out never exercised that right. So they just got to keep those premiums. And the coolest thing about the cash secured put strategy is that you can make money even when the stock market isn't making big moves or the stock market isn't rising. And the cash secured put is a strategy that we can do in a bull market, in a bear market, and in a sideways or neutral market. In fact, in a bear market, the premiums go up in value and we can get paid even more to buy the stocks we want as they go down in price, as they go on sale. And it's an amazing investment strategy. Now that you know the basics of trading options, you might be wondering, how much money do I need to actually trade options? Click on this video right here and I'll break down how much capital you need to start for beginner-friendly options trading strategies. If you found this video helpful, please like the video, subscribe to the channel, and hit the notification bell so you don't miss my next video.